So imagine waking up tomorrow, you check your bank account, and you realize you have, well, exactly enough cash to buy groceries for the next 14 days.
Just 2 weeks.
Right, 2 weeks. And after that, nothing. Like, there are no incoming deposits, no emergency credit line, literally no backup plan at all.
Which is terrifying for a single person, you know?
Exactly. But now imagine that scenario. But you aren't just one person. You are the government of a billion-person nation. Because in 1991, that was the actual terrifying reality for India.
Yeah, they were weeks away from total international bankruptcy.
Weeks away. And so it makes you wonder, right, how does a massive economy even get to that point? And more importantly, what are the actual mechanics of digging out of a hole that deep?
Well, it is basically the ultimate macroeconomic nightmare. And to really understand how it happens, you have to look under the hood of a nation's financial engine.
Right.
You have to look the diagnostic tools that policymakers, central bankers, and global investors actually use to measure the health of a country.
Which brings us perfectly to the mission for today's deep dive. Because if you are listening to this, there is a very good chance you are currently prepping for your MBA exams.
Oh, absolutely.
Yeah, and you are probably staring down Unit 7, which is the balance of payments and foreign exchange markets. And look, we know you have the textbook pages, you've got the charts, the formulas, they're all sitting right in front of you.
And textbook material can be pretty dry.
Oh, totally dry. But reading about international finance and actually, understanding how it breathes are two totally different things. So today, we are going to unpack those actual mechanics.
Yeah, we aren't just going to give you a list of definitions to memorize for your test. We want to explore the how and the why behind the global flow of money so that it just fundamentally makes sense to you.
Exactly. Because when you understand these concepts, you aren't just passing an exam. You actually gain a lens to view global events.
Right. You start to see how, say, a minor interest rate hike in Washington can cause a total currency panic in Mumbai, or how a technological boom in Bangalore can actually stabilize an entire national ledger.
Because it is all connected, right, through the balance of payments and the foreign exchange ecosystem. So I think we need to start at the bedrock. The balance of payments or the BoP.
Yes, the BoP.
Let's unpack the actual definition before we get into the crazy mechanics.
Yeah.
So for your exam, the BoP is defined as a statistical statement that summarizes all economic transactions of a country with the rest of the world over a specific time period, which is usually a calendar year.
And, every single word in that definition is doing some heavy lifting. It is a statistical statement, meaning it is an accounting document, essentially.
Right.
And it captures all economic transactions, like whether that is a massive corporation buying a whole fleet of airplanes or a migrant worker sending $50 home to their family, it all goes in.
Yeah.
And it strictly measures transactions between residents of the home country and the rest of the world. So internal domestic trade, that doesn't show up here at all.
Okay, so I always find it helpful to ground this in a personal analogy, especially for memory hooks. Think of your own annual financial summary, right?
Right.
You have your income, your salary, maybe some dividends from a stock you own, or even a loan you took out from a bank. Then you have your outflows, like your rent, the car you bought from overseas, your streaming subscriptions.
Yeah, all the money leaving your pocket.
Exactly. The BoP is exactly that, but aggregated for an entire sovereign nation. It is the literal dashboard that tells a government if they are bleeding wealth or if they're accumulating it.
And that dashboard dictates all their policy. I mean, a government cannot make intelligent decisions about taxation or domestic interest rates or trade tariffs without looking at the BoP first.
Right.
If your country is consistently importing far more than it exports, well, you are living beyond your means on a national scale. You are financing your current consumption by borrowing from foreign nations. So the BoP tells you exactly how sustainable your national lifestyle actually is.
But there's a really weird accounting quirk in how the BoP is structured. And it is a fascinating departure from standard corporate accounting.
Oh, examiners love testing this specific quirk.
Yes, they do. So it is built on the principle of double entry bookkeeping, which makes sense because every transaction has two sides. But the arrangement of the ledger is completely flipped.
It is a critical detail. So in standard business accounting, you typically record your assets or debits on the left side of the balance sheet and your liabilities or credits on the right side.
Right.
But the BoP reverses this convention completely. In a nation's balance of payments, the credits are recorded on the left side and the debits are recorded on the right side.
It seems like a super small detail, but it is exactly the kind of structural concept that examiners use to see if you actually understand the framework. Credits on the left, debits on the right.
Exactly.
But that begs a much larger operational question, I think. What actually qualifies as a credit versus a debit in international macroeconomics?
Well, it all comes down to a golden rule. It's a very simple mechanism. Just follow the foreign currency.
Follow the currency. Okay.
Right. If an economic transaction results in foreign currency flowing into your country, it is recorded as a credit. If a transaction causes foreign currency to flow out of your country, it's recorded as a debit.
Okay, so let's say an Indian agricultural firm sells a massive shipment of spices to a buyer in Europe. The European buyer obviously has to pay for that shipment.
Right.
So they send euros or dollars into India. Because foreign currency is arriving, that export is a credit.
Precisely. Exporting goods brings money in, therefore exports are always credits.
Yeah.
Conversely, if an Indian airline purchases a new fleet of jets from a manufacturer in the United States, well, they have to send money out of India to pay for those planes. Foreign currency is leaving the domestic ecosystem, therefore all imports are debits.
That is the ultimate baseline for the exam. Inflow equals credit, outflow equals debit.
But a national economy isn't just one giant, undifferentiated list of transactions.
Oh, it's highly structured.
Right, because we know the BoP tracks the flow of money, but a dollar coming in from selling a shipment of textiles isn't the exact same thing as a dollar coming in from a foreign hedge fund buying up local stocks. I mean, one is trade, the other is investment.
Yeah, entirely different economic drivers.
So how does a government actually separate the real physical economy from the financial casino?
They do it by dividing the BoP into two massive structural pillars. You have the current account and the capital account. And these two accounts track fundamentally different types of economic activity.
Okay, let's look at the current account first. This is the ledger for the day-to-day real economy, right? Exactly. It records all transactions related to goods, services, and income between residents and non-residents.
And for the exam, remember that the current account itself is split into two primary buckets. The first is merchandise trade. This is the super intuitive one. It represents the import and export of physical, tangible commodities.
Cars, consumer electronics, crude oil, agricultural products, textiles.
Right. Basically, if it can be loaded onto a cargo ship or if you can physically touch it, it is merchandise.
And when you subtract the total value of imported merchandise from the total value of exported merchandise, you get a very specific metric called the balance of trade.
Oh, okay.
And it is crucial to understand, and they will test this, that the balance of trade is not the balance of payments. It is just one subcomponent. It only measures the physical stuff.
Which is a vital distinction
Wow.
because modern economies trade a lot more than just physical stuff. And that brings us to the second bucket within the current account, which encompasses what are categorized as invisible items.
Yes, the invisibles.
These are the economic exchanges that don't involve a physical product crossing a customs checkpoint. And there are three specific subcategories here that basically drive the modern global economy. You have services, transfers, and income.
So let's break those down. Services form the absolute backbone of many advanced and developing economies today. This includes international travel and tourism.
Oh, right. Because when foreign tourists spend money at domestic hotels and restaurants, they are physically bringing foreign currency in.
Exactly. That is an invisible export. It also includes transportation, like international shipping and aviation fees. And, massively important for countries like India, it includes software services, business consulting, and financial services.
So an IT firm in Bangalore writing code for a bank in New York is generating a service credit on the current account. They aren't shipping a physical good, but they are exporting intellectual labor and bringing dollars into the country.
Precisely. Now, the next invisible category is transfers. And the defining mechanism of a transfer is that it is a transaction without a quid pro quo.
Meaning there is no direct exchange of value. It is just a one-way street.
Right. You are receiving money, but you aren't providing a good or a service in return, or vice versa. These can be official transfers, like foreign aid or international grants between governments. But the much more dynamic component consists of private transfers.
Remittances. I know this is a massive economic engine.
Oh, huge.
Like when a software engineer from Hyderabad moves to Silicon Valley and sends a portion of their U.S. salary back to their parents in India to support them, that is a private transfer. It brings foreign exchange into the country without requiring any domestic resources to be consumed or exported. For many developing nations, these migrant remittances are the primary stabilizing force for their entire current account.
They absolutely are. And the final invisible category is income. Now, this one often trips students up on exams because it sounds like it should belong in the investment section, right?
Yeah, income sounds like capital gains or something.
Right. But income on the current account refers to the return on an investment, not the initial investment itself.
Okay, got it.
So if a domestic resident owns shares in a foreign multinational corporation, the actual dividends they receive are recorded here. It also includes interest payments received on loans made abroad, or conversely, the interest a nation pays out on its foreign debts.
Okay, so to summarize the first pillar for the exam, the current account is the sum of merchandise trade plus services plus one-way transfers plus investment income. It is the snapshot of a nation's ongoing operational economic life.
That's a perfect summary.
But what happens when we look beyond the day-to-day operations and look at the underlying ownership of assets?
That is where we cross the boundary into the second pillar, the capital account. So while the current account tracks goods, services, and income, the capital account is entirely focused on the transfer of money to acquire assets or incur liabilities.
It is the ledger of foreign investment and foreign debt.
Exactly. And the structural breakdown of the capital account is highly specific, starting with foreign investment. There is a profound distinction here between two mechanisms: foreign direct investment, which is FDI, and portfolio investment.
And examiners will definitely ask you to compare these two.
They will. The difference between FDI and portfolio investment is fundamentally about control and permanence. FDI occurs when a foreign entity invests directly into the productive capacity of the domestic economy.
Like building a factory.
Right. They are building a manufacturing plant, acquiring a significant equity stake in a local company, or reinvesting their local earnings to expand operations.
So FDI is tangible and it is sticky. If an international automaker builds a billion-dollar factory in your country, they are making a really long-term commitment. They can't just panic and liquidate that factory overnight if the stock market dips.
Exactly. Portfolio investment, however, is highly liquid. This involves foreign institutional investors, or FIIs, purchasing financial assets like domestic stocks or bonds. They aren't looking for management control. They are just looking for financial returns. And because these assets are liquid, portfolio capital can be highly volatile. It can flow into an economy rapidly during a boom, and it can flee just as quickly at the first sign of trouble, which causes severe macroeconomic instability.
Right. Now, within the realm of portfolio investment and cross-border equity, there are two specific acronyms, two financial instruments that serve as a bridge between different global markets.
These are exam gold.
Yes. ADRs and GDRs. Because if you want to understand how a tech firm in Bangalore taps into Wall Street wealth without leaving India, you have to understand these. Let's unpack them.
Okay, so ADR stands for American Depository Receipt. Let's walk through exactly how this works. Suppose a massive Indian corporation wants to raise capital from American investors.
Okay.
But American retail investors might be super hesitant to open a foreign brokerage account, navigate Indian tax laws, and deal with currency conversion from dollars to rupees.
Yeah, the friction is way too high. Nobody wants to do that paperwork.
Yeah. Exactly. So to remove that friction, the Indian company issues shares, but instead of selling them directly to the American public, they deposit a massive block of these shares with an American depository bank, like, say, BNY Mellon or Citibank.
Okay.
The American bank holds these Indian shares safely in its vault. The bank then issues receipts, the actual ADRs, against those shares.
And these ADRs are traded on standard U.S. stock exchanges, like the New York Stock Exchange or the NASDAQ. They're priced in U.S. dollars, and they pay dividends in U.S. dollars.
Precisely.
Okay, wait. Let me push back on this, though. Let's unpack this for the listener. If I'm holding an ADR, am I investing in an American company?
Oh, this is a trap students often fall into on the exam.
Yeah.
No, you are not. The ADR is traded in the U.S., but it legally represents shares of a non-U.S. company. You are investing in the foreign company, just using American financial plumbing.
That makes perfect sense. Okay, so that's an ADR. And a GDR, a global depository receipt, operates on the exact same mechanical principle, but just on a wider scale.
Right. Exactly. Instead of being restricted solely to the U.S. market and U.S. regulations, a GDR is typically issued by an international bank. and can be traded on exchanges in multiple countries, often in London or Luxembourg.
So it's an instrument used heavily by companies in emerging markets to market their equity to global institutional investors.
Yes, exactly. So we have FDI representing long-term physical investment, and we have portfolio investments like ADRs and GDRs representing liquid equity.
Yeah.
But equity is only half the equation in the capital account. The other massive component is debt, loans.
Right. And the ledger tracks external assistance, short-term trade credit, and a major category known as external commercial borrowings, or ECBs.
Now, an ECB is a mechanism that allows domestic corporations or public sector undertakings, PSUs, which are just state-owned enterprises, to access foreign funding pools. So if an Indian infrastructure company needs to build a massive toll road, domestic banks might not have the capacity to lend them the hundreds of millions of dollars required. So the government permits the company to borrow commercially from foreign banks or foreign institutional lenders.
Now, it is crucial for your exam to draw a hard line between an ECB and FDI. They both represent foreign money coming into the country to fund corporate expansion. But the mechanics are entirely different.
It is the fundamental difference between debt and equity. An ECB is a loan. It is pure debt. The foreign lender does not own a piece of the infrastructure company. They simply hold a contract demanding that their principal be repaid, along with a fixed rate of interest, over a set timeline.
Right. So if I am an equity investor through FDI, I am riding in the passenger seat of the car. If the company thrives, my equity value skyrockets. But if the company crashes and goes bankrupt, my equity is wiped out. I share the risk.
Exactly.
But if I am an ECB lender, I am just the bank that financed the car. I expect my regular interest payments regardless of whether the company is highly profitable or struggling. My return is fixed, but my capital is legally prioritized during a bankruptcy.
Which is exactly why governments monitor ECBs so closely. Equity investments absorb economic shocks. Debt amplifies them. If a domestic currency depreciates rapidly, the cost of repaying a foreign currency-denominated ECB skyrockets, which can push totally healthy domestic companies into sudden insolvency.
Wow, yeah. And the final piece of the capital account puzzle is banking capital. This basically tracks the flow of commercial bank assets and liabilities, and notably, non-resident deposits.
Right.
When diaspora populations deposit their savings into specialized domestic bank accounts, that represents an inflow of capital that the banking system can then use to lend and stimulate the local economy.
So you take all of this, the trade and income recorded in the current account and the investments and loans recorded in the capital account, and you consolidate them. You calculate the net position of each.
But, I mean, calculating the net position of a multi-trillion-dollar economy down to the last cent has to be practically impossible, right? Data from customs ports, banking wires, and foreign exchanges don't always align perfectly in real time.
No, they almost never align perfectly, which introduces a necessary accounting mechanism.
Right.
The errors and omissions line item, it is the mathematical bridge.
All right.
Because the balance of payments uses double entry bookkeeping, the total credits must technically equal the total debits. If they don't, the discrepancy is simply recorded under errors and omissions to force the ledger into balance. It accounts for unrecorded capital flows, timing discrepancies in reporting trade, or just simple statistical inaccuracies.
Okay, so once that adjustment is made, you arrive at the overall balance. If your country brought in more foreign currency than it sent out, you have a surplus. If you sent out more than you brought in, you have a deficit.
Exactly.
And this final gap is settled through what the framework calls monetary movements.
Monetary movements are the final balancing mechanism, and they primarily involve changes in the country's official foreign exchange reserves. If you run an overall deficit, your central bank basically has to dip into its vault and sell off its reserves of dollars, euros, or gold to cover the shortfall. And if you run a surplus, the central bank buys up the excess foreign currency and adds it to the national vault.
And the central bank can also balance the books by drawing on international lifelines, specifically IMF's special drawing rights, right?
Yes, the SDR. It is a fascinating mechanism. It is essentially an artificial reserve asset created by the International Monetary Fund.
It isn't a physical currency you can spend at a store, though.
No. It is a basket of major global currencies: the US dollar, the euro, the Chinese yuan, the Japanese yen, and the British pound. The IMF allocates SDRs to member countries, and they act as the ultimate macroeconomic safety net. A country can exchange its SDRs with other nations for usable, hard currency to patch a hole in its BoP.
But when economists and policymakers look at this massive consolidated ledger, they don't treat all the numbers equally. There's a hierarchy of concern here. The metric that triggers the real alarm bells. The one that defines the structural health of an economy is the current account balance, the CAB.
Let's explore why the CAB is the definitive metric, because you need to understand this conceptually. If a nation is running a persistent deficit in its capital account, means it is investing heavily abroad or paying down foreign debt. That is generally manageable.
Okay.
But if a nation is running a persistent deficit in its current account, it means its fundamental day-to-day operations are broken.
It basically means the country is consistently importing more goods and services than it is exporting. It is consuming more than it is producing on the world stage.
Exactly. And to finance that overconsumption, the country must continually attract capital inflows. They have to borrow from foreign lenders or sell off domestic assets to foreign investors.
Right.
And if foreign investors suddenly lose confidence and stop providing that capital, the country has literally no way to pay for its vital imports like energy and food. The central bank has to burn through its foreign exchange reserves just to keep the lights on.
And when those reserves run out, you hit a brick wall. And that isn't just theory. That is exactly what happened to India, leading to the crisis we mentioned at the very beginning of this deep dive.
It is.
To truly understand these mechanisms for your exam, we need to look at India's macroeconomic history as a massive, real-world case study. Because over the decades, India's BoP has been hit by a series of lasting shocks.
The historical trajectory is basically defined by a few pivotal moments. You have the inward turn in the 1950s, the currency devaluation of 1966, the global oil shocks of the 1970s, the defining external payment crisis of 1991, and then the rapid modern transitions surrounding the 2008 global financial crisis.
Okay, let's wind the clock back. In the immediate post-independence era between 1950 and 1960, India was actually reasonably integrated with global trade. The sum of current receipts and payments hovered around 19% of the national GDP. But as the development paradigm shifted, policymakers adopted a radically different strategy.
They moved toward an inward-looking policy known as import substitution. And the underlying philosophy here was self-reliance. Instead of focusing on producing goods for export to earn foreign currency, the government decided to forcefully restrict imports and attempt to manufacture everything domestically. The policy apparatus was designed for import saving rather than export promotion. Heavy priority was directed toward domestic basic goods and capital goods sectors.
Now, on paper, self-reliance sounds pretty noble. But the economic mechanics of import substitution are actually brutal. Because the country practically abandoned export promotion, they severely strangled their ability to earn foreign currency. Yet, an industrializing nation still absolutely needs to import raw materials, advanced machinery, and energy.
The math simply didn't work. The structural deficit widened continuously. By 1969, the pressures had become so intense that the government was forced into a massive currency adjustment. The rupee was devalued by 36.5%.
Wow, 36.5%.
Yeah. In a single stroke, the purchasing power of the national currency on the global stage was slashed by over a third just to make exports artificially cheaper and imports punitively expensive.
Now, if you look at the ledger from this era, you will see a really strange anomaly. In the 1973-74 fiscal year, the current account actually swung into a surplus. It looks like the economy suddenly fixed itself. But the reality behind that number is a perfect lesson in how accounting can mask underlying weakness.
Oh, absolutely. That surplus was largely an illusion. It was not driven by a sudden boom in Indian manufacturing exports. The surplus was entirely generated by a massive spike in invisible receipts, specifically official government transfers.
Which requires explaining a fascinating piece of Cold War economic history, the PL 480 program. PL 480 was a United States Agricultural Act, often called Food for Peace. So throughout the 1950s and 60s, the U.S. had massive surpluses of wheat, and India was facing severe food shortages. But India didn't have the dollar reserves to actually buy the wheat. So the U.S. agreed to sell the grain to India and accept payment in Indian rupees, effectively trapping billions of rupees in U.S. government accounts within India.
Right. And then in February 1974, the U.S. and India reached an agreement regarding the disposition of those massive accumulated rupee funds. The U.S. essentially granted a huge portion of those funds back to the Indian government for developmental projects. On the balance of payments ledger, this massive debt forgiveness and fund transfer showed up as a colossal official transfer receipt. It instantly pushed the current account into a surplus, but it was a paper victory. It didn't reflect any actual improvement in India's industrial competitiveness or export capacity.
And whatever comfort that paper surplus provided was vaporized almost instantly by exogenous global forces. Because in October 1973, the first global oil shock hit.
Yeah, The geopolitical landscape shifted drastically, and the international price of crude oil skyrocketed. For an economy like India, which imports the vast majority of its crude oil, an oil shock is the ultimate macroeconomic wrecking ball.
Yeah, there's no way around it.
The mechanism is direct and unavoidable. You cannot run factories, transport food, or generate electricity without oil. You have to buy it, regardless of the price.
And the sudden drain on foreign exchange was just staggering. Before the shock, in 1972-73, crude oil accounted for roughly 11% of India's total import bill. By 1974-75, it had jumped to 26%.
Over a quarter.
Over a quarter of all foreign currency leaving the country was just to keep the basic internal engine running.
Now, the economy found brief stabilization as Indian exports to the newly wealthy oil-producing nations in the Middle East increased, and as migrant workers headed to the Gulf began sending remittances back home.
Right, the invisibles kicking in again.
Exactly. But then the second oil shock hit in 1979, followed by an international recession in the early 1980s. Export demand collapsed, and by 1981-82, the current account deficit was expanding dangerously again, reaching 1.8% of GDP.
This was the slow, agonizing buildup. The structural rot of the import substitution era, combined with external energy shocks, was really setting the stage for the defining trauma. We are back to the scenario we opened with, the 1991 crisis.
This is the hinge upon which modern Indian economic history turns, and it's a major case study for exams. It is a textbook example of a perfect storm. The underlying chronic illness was a heavily overvalued currency and decades of structural current account deficits. But the acute crisis was triggered by a specific cascade of 7 compounding conditions. Let's dissect how they interacted, step by step.
Okay, here we go. Condition 1, runaway government spending. By 1991, the combined fiscal deficit of the central and state governments had ballooned to 11% of GDP.
The government was simply spending vastly more than it was collecting in revenue. To fund this domestic spending spree, they had to borrow heavily, which leads directly to condition 2. Total public debt reached a staggering 60% of gross national product.
Wow.
The debt burden was consuming the national budget, leaving basically no room for productive investment.
And condition 3 was the inevitable result of this internal imbalance spilling into the external sector, the absolute depletion of foreign currency reserves. As we mentioned, reserves dipped below 1.0 billion US dollars, barely enough to cover a few weeks of essential imports.
Condition 4. High domestic inflation. When a government runs massive deficits, it often resorts to expanding the money supply, which drives up domestic prices.
Right.
And high inflation is fatal to international trade. If it costs vastly more to manufacture a shirt in India than it does in a neighboring country, well, Indian exports become completely uncompetitive globally. Export revenues dry up just when you need them most.
Then the external environment delivered the knockout blow. Condition 5. The geopolitical crisis in the Middle East. In 1990, Iraq invaded Kuwait.
This triggered an immediate severe spike in global oil prices. India's import bill exploded overnight again. But the Gulf War was a double whammy for India. Not only did energy costs soar, but the war displaced hundreds of thousands of Indian migrant workers living in the Gulf region. They had to flee the conflict zone,
Which instantly severed the lifeline of private remittance transfers. The invisible receipts that had been propping up the current account simply vanished.
Exactly. And this systemic shock shattered international confidence, leading to Condition 6, the withdrawal of non-resident Indian or NRI deposits.
The diaspora panicked.
Right. They looked at the skyrocketing oil prices, the plummeting reserves, and the domestic inflation, and realized a default or massive devaluation was imminent. They began pulling their foreign currency deposits out of Indian banks, accelerating the capital flight.
And finally, Condition 7, the institutional verdict. International credit rating agencies downgraded India's sovereign debt. This downgrade meant that commercial banks and foreign institutions either refused to lend to India altogether, or they demanded exorbitant interest rates that the country simply couldn't afford.
So when you trace the mechanics, domestic deficits fueling inflation, destroying export competitiveness, colliding with an external oil shock, erasing remittances, triggering capital flight, and ending in a credit downgrade, you see how every single lever of the BoP was pulled in the wrong direction simultaneously. The country was financially paralyzed.
The government was actually forced to physically airlift gold reserves to London to secure emergency loans from the IMF just to avoid defaulting on sovereign obligations.
It was a very dark time.
But a bailout is a band-aid, not a cure. The cure required dismantling the very system that caused the disease in the first place.
Which brings us to the turnaround. In the summer of 1991, a new government took power. Prime Minister P.V. Narasimha Rao and his finance minister, Dr. Manmohan Singh, initiated the new economic reforms. They recognized that the inward-looking, highly regulated regime had totally failed.
They executed a severe adjustment in the exchange rate, significantly devaluing the rupee to make exports competitive again. But more importantly, they initiated sweeping structural reforms across the financial, industrial, and trade sectors.
Yeah, they dismantled the complex system of licenses and quotas that had suffocated private enterprise, and they began integrating the Indian economy with global supply chains.
The pivot was historic, and the macroeconomic data reflects the success of this integration. By the turn of the millennium in 2001, the external sector showed a remarkable transformation. The overall current account deficit narrowed to a highly manageable 0.5% of GDP.
And what's truly fascinating is how the composition of the balance of payments changed to drive this recovery, because it wasn't just traditional manufacturing that saved the day.
Exactly. Even when the economy faced new pressures in 2000, like a resurgence in oil prices and a global downturn in equity markets, the BoP remained comfortable because of two massive structural shifts. First, on the capital account side, the government successfully mobilized massive foreign funds under the India Millennium Deposit Scheme, effectively tapping into the wealth of the global diaspora.
And second, on the current account side, India experienced a dynamic surge in export performance driven by an entirely new sector, software services.
The IT boom.
Yes, the IT boom fundamentally altered the trajectory of the Indian economy. We talked about invisible exports earlier. Well, software engineering, business process outsourcing, and IT consulting became colossal engines of foreign exchange. India discovered a way to export high-value intellectual capital to the West without the massive physical infrastructure and raw material imports required by traditional heavy industry.
Selling code overseas brought billions of dollars into the BoP ledger, providing a buffer against the volatility of global commodity markets. It is a perfect example of how a technological shift creates a completely new macroeconomic reality.
But integration into the global economy is a double-edged sword. When you tear down the walls, you invite both foreign capital and foreign contagion. And this became acutely evident during the 2008 global financial crisis.
The 2008 crisis originated in the United States housing market, but it spread like a wildfire through the interconnected global banking system, engulfing Europe, Asia, and Japan.
Right. And because India had liberalized its financial and trade sectors, the domestic economy was highly exposed to the transmission of this crisis. The contagion spread through two primary channels. The trade channel. As Western economies collapsed into recession, demand for Indian exports plummeted.
Naturally.
And the financial channel. Panicked, global investors rapidly pulled portfolio capital out of emerging markets to cover the massive losses at home, causing a severe shock to the capital account.
Yet despite this intense dual shock, the fundamental resilience built since 1991 held. The domestic banking system was relatively insulated from toxic mortgage assets. While growth slowed, India still registered a robust 7% growth rate during the 2009-10 period.
In fact, the BoP actually improved rapidly post-crisis. As global central banks slashed interest rates to zero to save their own economies, massive waves of speculative capital went searching for yield. That capital flooded back into high-growth emerging markets like India, leading to a surge in foreign exchange reserves and a period where the rupee actually appreciated in value.
But the global landscape has remained persistently volatile ever since. The macroeconomic environment today is shaped by a complex web of ongoing influences. We can look at 5 specific external forces that continuously pressure the modern BoP. Examiners will want you to know these.
Let's list them. First is the fundamental sluggishness of the developed world. The slow and uneven economic recovery of the U.S. and the European Union post-2008 means that the traditional engines of global consumption just aren't pulling as hard as they used to, which suppresses export growth.
Second is political fragmentation, specifically events like Brexit, the decision of Britain to exit the European Union. When a major trading partner rips up its trade agreements, it injects massive uncertainty into the market. Businesses delay investments, supply chains are rerouted, and currency values fluctuate wildly.
Third is sovereign debt instability. The European sovereign debt crisis, often remembered by the acronym PIIGS, Portugal, Italy, Ireland, Greece, and Spain, threatened the very survival of the euro.
Right.
When an entire currency bloc is at risk of fracturing, global financial flows seize up, impacting capital availability for developing nations.
Fourth is the structural shift in the Chinese economy.
Yeah.
After decades of blistering double-digit expansion, China's growth rate has naturally decelerated.
And the mechanics of a Chinese slowdown are complex for a country like India. On one hand, because China is the world's largest consumer of raw materials, a slowdown in their industrial engine suppresses global commodity prices. For an importing nation, cheaper oil and cheaper metals are a massive benefit to the current account.
That's the upside.
Right. But on the other hand, if a major global growth engine stalls, it dampens the entire global trade environment.
And finally, the fifth and perhaps most immediate lever, the monetary policy of the advanced economies. The actions of the U.S. Federal Reserve, the European Central Bank, the Bank of England, and the Bank of Japan dictate the tide of global capital.
The clearest example of this was the taper tantrum of 2013. The U.S. Federal Reserve simply just hinted, that it might begin tapering or slowing down its massive bond buying program.
Just a hint caused it.
Yeah. The mere suggestion that U.S. interest rates might rise caused global investors to panic. They instantly ripped billions of dollars of portfolio investment out of emerging markets, including India, to move it back to the safety of U.S. Treasury bonds.
That sudden reversal of capital flows put immense downward pressure on the rupee, forcing the central bank to scramble to defend the currency. It proves that in a liberalized system, your domestic stability is inextricably linked to decisions made in Washington or Frankfurt.
Which actually serves as the perfect transition. We spent a lot of time talking about the macro ledger, the BoP, and how money flows across borders, but we really need to zoom in on the actual plumbing.
The mechanics of it.
Right. How does a rupee physically or electronically become a dollar? Where does that transaction actually take place?
That brings us to the operational heart of international finance, the foreign exchange market ecosystem. Let's start with a very simple, practical scenario to define the concept of foreign exchange.
Okay, imagine a tourist from Germany who travels to Kerala in southern India to undergo a specialized Ayurvedic medical treatment. The tourist has euros sitting in their bank account in Berlin, but the Ayurvedic clinic in Kerala operates in the local economy. They need to pay their doctors, their suppliers, and their electricity bill in Indian rupees.
Because a currency's legal power stops at its national border. The clinic cannot take those euros to the local grocery store.
Exactly. There is a fundamental mismatch. The source of the purchasing power is in one currency, but the utilization of that purchasing power must happen in another.
Foreign exchange is the mechanism that bridges that gap. It is the process of converting the currency of one country into the currency of another, facilitated through the intermediation of the banking system. It also refers to the rate at which that conversion happens, the price of one currency expressed in terms of another.
Now, in the context of Indian law, there is a very specific technical definition provided by the Foreign Exchange Management Act, FEMA, of 1999. It states that foreign exchange means foreign currency and explicitly includes 3 categories of financial instruments.
Let's break those down for the students. The first category includes deposits, credits, and balances payable in any foreign currency. This is straightforward. If you hold a bank account denominated in U.S. dollars, that balance is foreign exchange.
The second category gets into the instruments of trade. It includes drafts, traveler's checks, letters of credit, or bills of exchange that are expressed or drawn in Indian currency but are payable in any foreign currency.
And the third category is the inverse. Drafts, traveler's checks, letters of credit, or bills of exchange drawn by banks, institutions, or persons outside India, but which are payable in Indian currency.
Basically, the law casts a very wide net. It isn't just about physical stacks of foreign banknotes. Any financial contract, credit instrument, or banking mechanism that crosses the currency border is legally defined and regulated as foreign exchange. And the global decentralized network of telecommunications and electronic trading platforms where these instruments are bought and sold is the foreign exchange market.
So what does this all mean in practice? What is the actual economic utility of this massive, multi-trillion-dollar daily market? It doesn't just exist to facilitate tourism.
No, definitely not.
It performs 3 vital load-bearing functions for the global economy. Function number 1 is the transfer function.
This is the most basic plumbing. The market facilitates the physical or electronic transfer of purchasing power between countries. It utilizes foreign bills, telegraphic transfers, and bank drafts to clear the international settlement of claims simultaneously.
Right.
It ensures that when a Japanese electronics firm sells televisions in Canada, the Canadian dollars are efficiently converted and transferred to the firm's accounts in Tokyo as yen.
Function number 2 is where the banking system really flexes its muscle, the credit function. This is entirely about financing international trade.
Let's unpack the mechanics of trade credit because it's fascinating. In domestic business, you might pay cash on delivery, but international trade involves massive cargo ships and long transit times. An exporter in Brazil might sell a shipment of coffee to an importer in the UK. The UK importer negotiates a 90-day payment term. They want time to receive the coffee, roast it, package it, sell it to supermarkets, collect the revenue, and then pay the Brazilian exporter.
But the Brazilian exporter has immediate costs. They have to pay the farmers who grew the coffee today. They can't wait 90 days.
This is where the Forex market provides liquidity. The Brazilian exporter holds a legally binding bill of exchange, a promise from the UK importer to pay in 90 days. The exporter takes this bill to their commercial bank. The bank accepts the bill and immediately advances the cash to the exporter, minus a small discount fee for the service.
The exporter gets their working capital instantly. The importer gets their 90 days to generate revenue. And the commercial bank holds the risk and collects the payment from the importer when the 90 days are up. The foreign exchange market provides the underlying credit mechanisms that basically grease the wheels of global commerce.
Which brings us to the third and arguably most complex function, hedging. The Forex market provides advanced financial facilities for individuals and corporations to protect themselves against the inherent risks of fluctuating exchange rates.
We're going to dive incredibly deep into the mechanics of hedging in just a moment. But first, let's identify the cast of characters. Who is actually sitting at the terminals executing these massive trades?
Good question.
The ecosystem is driven by 4 main tiers of participants.
The first tier consists of the corporates and investors. These are the end users of the market. Multinational corporations like Apple or Toyota buying parts globally, institutional investors shifting capital, and local business houses engaged in import-export. They interact with the market primarily to facilitate their underlying commercial activities.
The second tier are the commercial banks. They're the absolute workhorses of the system.
Yes. When a corporate client needs to buy 10 million euros, they don't go to the market directly. They call their commercial bank. The banks execute trades on behalf of their clients, but crucially, they also operate as market makers on their own accounts.
Right.
They trade currencies continuously to profit from microscopic movements in exchange rates. The vast majority of the volume in the Forex market is interbank trading.
The third tier are the exchange brokers.
Think of brokers as the superconnectors.
Yeah.
If hundreds of commercial banks had to constantly call each other to find a buyer or seller at the exact right price, the system would just grind to a halt. It is terribly inefficient.
Yeah, that would be a nightmare.
Exactly. So exchange brokers sit in the middle of the banks. They aggregate all the buy and sell orders. They find the most favorable quotations instantly and execute the deals for a tiny commission, saving the banks immense time and search costs.
And sitting at the absolute top of the pyramid is the fourth tier. The central banks. They are the referees,
Right.
but they carry a massive financial bazooka.
The central bank, well, they actually don't trade for profit. Their mandate is macroeconomic stability. If a sudden geopolitical shock causes panic and massive speculative selling threatens to collapse the value of the national currency, the central bank intervenes. They enter the Forex market and use their foreign exchange reserves to massively buy up their own currency, absorbing the selling pressure and stabilizing the exchange rate.
In the Indian context, the ultimate authority is the Reserve Bank of India, the RBI. They constantly monitor the market and intervene, sometimes directly or often by routing their massive trades through the State Bank of India, the SBI, to mask their movements and curb erratic speculation. And as a geographic note for your exams, Mumbai remains the undisputed nerve center of the Indian foreign exchange market, although the RBI has authorized widespread decentralization to regional hubs like Kolkata, Chennai, and Delhi to handle the massive volume of a modern economy.
So we have the players and the structure. Now we need to look at the actual instruments they trade. We need to dissect the mechanics of currency risk and the different types of exchange rates based on time.
Time is the crucial variable in international finance. The simplest transaction happens in what is called the spot market.
The spot exchange rate is the rate for immediate delivery. Now, in the banking world, immediate usually means the transaction clears within 1 or 2 business days. It is the real-time price of a currency, determined minute by the current intersection of global demand and supply.
So if you check an app on your phone to see the value of the rupee against the dollar right now, you are looking at the spot rate.
Exactly. But as we discussed with our Brazilian coffee exporter, international business rarely operates on a real-time cash-and-carry basis. Long production cycles and slow shipping routes define global trade. This necessity created the forward market.
A forward contract is an agreement to buy or sell a specific amount of foreign currency at a specific date in the future, say 30, 60, 90, 180, or even 360 days from now. But the crucial mechanic is that the price for that future transaction is negotiated and locked in today.
Right.
That agreed-upon future price is the forward rate.
And the forward rate is almost never the same number as today's spot rate. It reflects the market's mathematical expectation of how interest rates and inflation will evolve over that time period.
This difference creates a vital piece of terminology you absolutely must understand for exams. If the forward rate of a currency is higher than its present spot rate, that currency is said to be trading at a premium.
So if the spot rate for a euro is 85 rupees, but a 90-day forward contract prices the euro at 87 rupees, the euro is at a premium. The market expects it to gain value.
Exactly. And conversely, if the forward rate is lower than the present spot rate, the currency is trading at a discount. It is a simple metric of market sentiment and interest rate differentials.
But understanding the terminology is just the start. Let's look at how these instruments, specifically currency derivatives, are actually utilized.
Okay, here's where it gets really interesting, though. Because the word derivative has a terrible reputation, right? I mean, isn't a derivative just a fancy way for Wall Street to gamble on currencies?
That's a very common misconception. While speculators certainly use derivatives, their core fundamental purpose in the foreign exchange ecosystem is the exact opposite of gambling. They are tools for risk elimination.
Oh, really?
Yes, they are the mechanism that fulfills the hedging function we mentioned earlier. Let's build a concrete scenario to show exactly how a derivative saves a business.
Let's do it. Imagine an advanced heavy machinery manufacturer located in Pune, India. They win a massive contract to design and build custom industrial equipment for a buyer in Germany. The manufacturing process is complex. It is going to take exactly 6 months from signing the contract to final delivery.
The German buyer demands to pay in their local currency. They agree to a contract price of exactly 1 million euros, payable upon delivery 6 months from today.
The manufacturer in Pune sits down and does the math. Their costs, labor, steel, electricity, taxes, are all in Indian rupees. Let's say today's spot rate is 90 rupees to the euro, so 1 million euros equals 90 million rupees. They calculate that their total cost of production is 81 million rupees. Therefore, at today's exchange rate, they are projecting a healthy 10% profit margin of 9 million rupees. They sign the deal and start building.
But the global currency market never sleeps.
Yeah.
Over the next 6 months, while the engineers are building the machine, a crisis erupts in Europe. The European Central Bank slashes interest rates, or a major geopolitical conflict erupts. The value of the euro plummets against the rupee.
By the time the machine is delivered and the 1 million euro payment arrives, the spot rate has crashed from 90 down to 80.
Let's look at the catastrophic math here. The manufacturer takes their 1 million euros to the bank. At the new spot rate of 80, they only receive 80 million rupees. But their cost of production was 81 million rupees.
Their entire 10% profit margin is completely annihilated, and they actually suffer a 1 million rupee loss.
Yeah.
They executed the project perfectly. They built a flawless machine on time, but they lost money entirely because of an external variable they couldn't control, exchange rate volatility.
This is an unacceptable risk for any modern corporation. It makes long-term planning basically impossible. And this is exactly where a currency derivative, specifically a forward contract, comes to the rescue.
Let's rerun the exact same scenario, but this time the CFO of the manufacturing firm uses a derivative.
On the exact day they sign the contract with the German buyer, the CFO calls their commercial bank. They enter into a forward contract to sell 1 million euros to the bank 6 months from today. The bank looks at the interest rate differentials and quotes a forward rate. Let's say the forward rate is 89.
The CFO locks in that rate. It is a legally binding contract. The value of this contract is derived from the underlying currency, hence the term derivative.
Fast forward 6 months, the euro crashes to 80 again. The German buyer pays the 1 million euros. But the Indian manufacturer doesn't have to accept the disastrous spot rate of 80. They exercise their derivative contract. The commercial bank is legally obligated to buy those euros at the locked-in rate of 89.
The manufacturer receives 89 million rupees. Their cost was 81 million. They preserve a robust profit of 8 million rupees. They paid a tiny premium, accepting 89 instead of the initial 90, but they completely eliminated the catastrophic downside risk.
That is the true function of a currency derivative. It is an insurance policy that allows businesses to focus on making products rather than gambling on macroeconomic volatility.
And while corporations manage risk at the micro level through derivatives, governments must manage volatility at the macro level through their choice of an overall exchange rate system.
This is a critical structural decision for any nation. Before we compare the systems, the source material insists on a vital terminology check. We touched on this briefly, but it is so heavily tested that we must define it clearly.
Yeah, pay attention here.
It is about how we describe a currency's loss or gain in value, and it depends entirely on the underlying system. The terminology designates who is causing the change in value. Under a fixed exchange rate system, the government or central bank has total control. When the monetary authority makes a deliberate, official policy decision to decrease the external value of their currency, it is called a devaluation.
That is what India did in 1966 and 1991. It was an active, intentional cut. And if a government officially increases the value, it is called a revaluation.
Exactly. However, under a floating exchange rate system, the government steps back and lets the market dictate the price. When market forces, the daily interception of supply and demand, cause the value of the currency to decrease, it is called depreciation.
And when market forces cause the value to increase, it is called appreciation.
Devaluation and revaluation require a government decree. Depreciation and appreciation are organic market movements. Keep those distinct in your mind. Functionally, a decrease in value, whether by devaluation or depreciation, means that it now requires more units of your home currency to purchase a single unit of foreign currency. Your money simply buys less abroad.
So let's analyze the two extreme ends of the spectrum, starting with the fixed exchange rate system. Historically, this was the global norm under the gold standard, and later under the Bretton Woods system. Today, it refers to a system where a country's monetary authority strictly pegs the external value of its currency to a predetermined level, usually against a major currency like the US dollar or a basket of currencies.
The central bank declares a par value and guarantees that all international transactions will take place at or extremely near this rate. But maintaining a peg isn't just about passing a law, it requires massive firepower.
Right.
If market forces try to push the value away from the peg, the central bank must forcefully intervene. If the currency is facing downward pressure, the central bank must sell its foreign reserves and buy its own currency to artificially prop up the price.
So why would a country voluntarily take on the immense burden of constantly defending a fixed rate? What are the economic arguments favoring this strict control?
There are four very powerful macroeconomic arguments for a fixed system. The first is the promotion of international trade. A fixed rate eliminates exchange risk entirely. Our manufacturer in Pune wouldn't need to buy a complex derivative contract if the rupee to euro exchange rate was permanently fixed. Absolute certainty reduces friction, which stimulates the volume of global trade.
The second argument is the promotion of international investment. Capital is inherently cowardly. It seeks safety. A foreign corporation is far more likely to invest billions in building infrastructure in a developing country if they have a cast-iron guarantee that the value of their investment won't be wiped out overnight by a sudden, volatile currency depreciation. A credible fixed rate acts as a beacon for long-term FDI.
The third argument is the prevention of destabilizing speculation. By definition, if an exchange rate is permanently fixed and the central bank has the massive reserves required to credibly defend it, there is no profit to be made by currency speculators. It completely removes the casino element from the currency market.
And the fourth argument is perhaps the most fundamental: inflation control.
Yes. When a central bank commits to a fixed exchange rate, it essentially surrenders its ability to recklessly print money. If they print too much domestic currency, inflation rises, imports become cheaper relative to domestic goods, the trade deficit explodes, and the peg collapses.
Yeah.
Therefore, the commitment to the peg forces the government to maintain extreme fiscal and monetary discipline, keeping domestic price levels stable.
It sounds ideal. Absolute certainty, high investment, zero speculation, and low inflation. But the real world is incredibly dynamic, and defending a static price against the relentless tide of global economics eventually breaks most fixed regimes. Which leads us to the opposite pole, the floating exchange rate system.
In a pure floating system, the government does absolutely nothing. The exchange rate is determined entirely by the free market mechanics of demand and supply for foreign exchange. If a country imports massively, the demand for foreign currency surges, and the home currency naturally depreciates.
And there are 5 distinct advantages to surrendering control to the market. Number 1, the automatic adjustment of the balance of payments.
This is the most elegant mechanism of a float. Under a fixed system, a trade deficit just drains your reserves until you collapse. Under a floating system, the deficit is self-correcting.
Oh, that's cool.
Right. If you import too much, your currency naturally depreciates. This depreciation automatically makes your exports vastly cheaper for the rest of the world and makes foreign imports painfully expensive for your citizens. Without the government doing anything, export demand rises, import demand falls, and the BoP naturally moves back toward equilibrium.
Number 2, better liquidity. Because the central bank is not obligated to defend a specific price target, it doesn't need to hoard massive, unproductive stockpiles of foreign exchange reserves. Those resources can be deployed more efficiently elsewhere in the economy.
Number 3, gains from free trade. Countries trying to defend a fixed peg often resort to draconian capital controls, massive import tariffs, or rationing of foreign exchange to prevent money from fleeing. A floating system removes the need for these artificial restrictions, allowing capital and goods to flow to their most productive global uses.
Number 4 is massive for domestic politics, independence of policy.
Yes, in a fixed system, your central bank's primary job is defending the peg. If U.S. interest rates rise, you have to raise your domestic rates to prevent capital flight, even if your local economy is in a recession and desperately needs low rates.
Right.
In a floating system, the exchange rate acts as a shock absorber. The currency takes the hit, allowing the central bank to set domestic interest rates entirely based on internal needs, like fighting unemployment.
And finally, number 5, the establishment of a true cost-price relationship. A floating rate isn't an arbitrary number determined by a bureaucrat. It reflects the aggregate intelligence of the global market, providing the most accurate pricing signal for the true competitive value of the national economy.
So we have two extremes. The fixed system offers absolute stability but requires massive reserves, sacrifices domestic policy independence, and risks catastrophic failure if the peg breaks. The floating system offers automatic adjustment and policy freedom, but subjects businesses to the relentless volatility of the market, necessitating complex hedging strategies.
But wait, how does the real world actually operate? Because neither extreme works perfectly in reality.
No, they don't. Which is why the vast majority of the modern global economy operates in the middle ground using hybrid exchange rate systems. The goal is to blend the stability of a peg with the flexibility of a float.
The source material identifies 4 main variations of these hybrid systems. First is the system of exchange rate bands. The government selects a defined, acceptable range within which the currency is allowed to float freely. But there is a hard floor and a hard ceiling.
Right.
If the market pushes the currency to the edge of the band, the central bank intervenes. The post-WWII Bretton Woods system operated on a highly restrictive band, allowing only a 1% fluctuation around the par value.
The second variation is the adjustable peg. This operates like a fixed system on a day-to-day basis with a defined par value. However, it incorporates an escape clause. If the country faces a fundamental structural disequilibrium in its balance of payments that cannot be solved by normal market intervention, the government retains the legal right to officially reset the par value to a new level.
The third approach is the crawling peg. This is a brilliant mechanism for economies suffering from high inflation. Instead of holding a completely unrealistic fixed rate for years and then executing one massive dramatic devaluation that shocks the economy, the government announces that it will adjust the par value frequently in highly predictable microscopic amounts.
Exactly.
Because the market knows exactly when and by how much the currency will devalue, it completely eliminates the incentive for destabilizing speculation.
And the fourth hybrid model is managed floating. This is the dominant model for most large emerging markets today. The underlying principle is that the currency is floating. Its long-term trajectory is determined entirely by macroeconomic fundamentals and market forces. However, the central bank reserves the right to intervene aggressively to smooth out excessive short-term volatility or panic-driven fluctuations. They don't try to stop the tide, but they prevent the waves from smashing the boat.
And this is exactly the system that India operates today. The RBI maintains a managed float. They let the rupee find its natural market value, but if external shocks cause erratic, violent swings, they deploy their reserves to restore order to the market.
But this entire discussion of floating and managed systems ultimately hinges on one profound question. If the market is deciding the value of the currency, what underlying economic forces is the market actually reacting to? What determines the true equilibrium exchange rate between two sovereign nations?
This takes us into the realm of pure economic theory. We are looking at Section 7, the economics of exchange rates. And there is one monumental theory that attempts to answer this exact question, one that you will undoubtedly be tested on. It's called purchasing power parity, or PPP.
The theory of purchasing power parity was introduced by the Swedish economist Gustav Cassel during the massive currency upheavals following World War I in 1918. Cassel wanted to find a fundamental anchor for exchange rates, and he built his theory on a very intuitive, logical foundation known as the law of one price.
Let's unpack the law of one price. It is a thought experiment. It asks you to imagine a perfectly frictionless, perfectly competitive global market. In this hypothetical world, there are absolutely no transportation costs. Moving a massive shipping container from Mumbai to New York costs $0.
Right, pure fantasy, but stick with it.
Yeah, exactly. Furthermore, there are no trade barriers, no tariffs, no quotas, no taxes.
Under those mathematically perfect conditions, the law of one price states that an identical good must sell for the exact same price globally when expressed in a common currency.
Why must it be the same price? Because of a powerful market force called arbitrage. Let's look at the mechanics. Suppose a specific model of a laptop costs $1,000 in New York, and suppose the exact same laptop costs the equivalent of $1,200 in New Delhi.
In a frictionless market, that price discrepancy simply cannot last. Traders will immediately spot the difference. They will buy thousands of laptops in New York at the cheap price of $1,000. They will instantly ship them to New Delhi for free and sell them for $1,200, pocketing a massive risk-free profit.
But the very act of executing this arbitrage trade destroys the opportunity. By buying aggressively in New York, the traders increase the demand for the laptop, driving the U.S. price up. By flooding the New Delhi market with supply, they drive the Indian price down. This process continues relentlessly until the prices perfectly equalize. The arbitrageurs force the global establishment of one price.
Based on this rock-solid logic, Cassel developed two versions of his theory to explain exchange rates: the absolute version and the relative version.
The absolute version of PPP is the most direct application of the law of one price. It postulates that the equilibrium exchange rate between two currencies is determined by the ratio of their domestic price levels. It assumes that a basket of identical goods should cost exactly the same in both countries when converted.
The mathematical formula provided in the source is brilliantly simple. R equals P divided by P star. R represents the exchange rate. P represents the aggregate price level of goods in the home nation, and P star represents the price level in the foreign nation. The exchange rate is simply a mirror reflecting the difference in absolute prices. If the general price of goods in America doubles while Indian prices stay flat, the dollar must depreciate by exactly half against the rupee to maintain parity.
But as elegant as the math is, the absolute version of PPP falls apart upon contact with reality. And you need to be able to articulate why it fails for your exams.
It fails because the foundational assumptions of the law of one price do not exist in the physical world. We do not live in a fictionless utopia.
Right.
Transportation costs are massive. Shipping a car across the Pacific Ocean requires fuel, insurance, and massive logistical networks. Tariffs and trade barriers absolutely exist. Governments tax imports to protect domestic industries. Furthermore, many goods and services simply cannot be traded internationally. You cannot arbitrage a haircut or a real estate property. Because of these massive permanent frictions, absolute prices across nations rarely equalize perfectly.
Cassel recognized this flaw, which is why he developed the second iteration, the relative version of PPP. Instead of trying to compare static absolute price levels, which is impossible, the relative version focuses on the dynamic change in prices over time.
This is the version that actually provides immense analytical value in the real world. Relative PPP concedes that a basket of goods might cost more in London than in Mumbai due to shipping and taxes. But it states that over a period of time, the change in the exchange rate between the pound and the rupee will be directly proportional to the relative change in the price levels between the two nations.
So we're basically talking about the inflation differential.
Precisely. Let's look at the exact example provided in the text to lock this concept in. Suppose we are tracking the exchange rate between the Indian rupee and the US dollar. Over the course of a year, India experiences an inflation rate of 10%. Domestic prices are rising rapidly. During the exact same year, the United States experiences an inflation rate of only 5%.
The difference between the two, the inflation differential, is exactly 5%.
Because India's inflation is significantly higher, the purchasing power of the rupee within India is decaying much faster than the purchasing power of the dollar within the US. If the exchange rate remains static, Indian goods would suddenly become 5% more expensive for the rest of the world, devastating their export economy.
But the market corrects for this. According to relative PPP, because India has 5% higher inflation, the exchange rate of the rupee must depreciate by exactly 5% against the dollar over that same time period to restore equilibrium and maintain trade competitiveness.
Higher relative inflation mathematically dictates a depreciating currency over the long run. That is the core takeaway. It is the invisible tether connecting domestic monetary policy to international valuation.
And the source material leaves us with a highly testable, logical rule of thumb regarding the relationship between the two theories. Here it is. If absolute PPP holds true, then relative PPP must automatically also hold true. If absolute prices are perfectly equal, then any change in those prices will be perfectly mirrored in the exchange rate.
However, the inverse is not necessarily true. If relative PPP holds, meaning the exchange rate is accurately adjusting for the inflation differential over time, it does not mean that absolute PPP holds. The baseline prices might still be wildly different due to transportation costs and tariffs. Relative PPP is simply the more robust, realistic tool for analyzing long-run macroeconomic movements.
It is a profound framework. It shows that a nation cannot recklessly print money and generate massive domestic inflation without the global Forex market ruthlessly punishing their currency's value.
Which perfectly frames the final act of our deep dive. We've explored the abstract theories, the accounting structures, and the market mechanics. Now we need to look at how the government of India has actually wrestled with these forces over time. We need to trace the evolution of Indian Forex policy.
It is a fascinating narrative arc. It is the story of a nation moving from a paradigm of suffocating absolute control to a paradigm of cautious, managed liberalization.
The timeline of institutional structure really begins in 1958. Recognizing the need for standardized practices, the Foreign Exchange Dealers Association of India, FEDI, was established. Its mandate was to help the government frame rules, set standard guidelines, and determine banking charges for conducting foreign exchange business.
But the true character of the early era was defined in 1973. This was the peak of the inward-looking import substitution philosophy we discussed earlier. In 1973, the government enacted FERA, the Foreign Exchange Regulation Act.
FERA is legendary in Indian economic history for its draconian severity. It was not designed to facilitate trade, it was designed to police it. The act operated on the assumption that foreign exchange was an exceedingly scarce national resource that had to be hoarded and micromanaged by the state.
Under FERA, the level of control was absolute. It strictly regulated any activity remotely connected to foreign exchange, foreign securities, or the indirect export of currency. The most staggering aspect was the mandatory surrender requirement.
Yes. If a company exported goods or if a resident somehow earned foreign currency abroad, they were strictly prohibited from keeping those funds. They were legally mandated to surrender absolutely all foreign exchange earnings to the Reserve Bank of India at an exchange rate unilaterally dictated by the RBI.
Wow.
You couldn't hold dollars, you had to trade them for rupees at the government's price. The government completely centralized the allocation of foreign exchange, severely rationing who was allowed to import technology or machinery.
It was an attempt to defy the market mechanics we just spent an hour discussing. And as we saw in the timeline of crises, that rigid, inflexible system ultimately cracked under the pressure of global oil shocks and domestic deficits, culminating in the complete breakdown of 1991.
The 1991 crisis proved that you cannot regulate your way out of a balance of payments deficit. The subsequent new economic reforms initiated in 1992 signaled the end of the command and control era. The government realized that to grow, they had to integrate.
Right.
They initiated a gradual process of liberalization, dismantling the restrictive quotas and allowing the exchange rate to become market-oriented.
This decade of philosophical shift culminated in the year 2000. The government officially repealed the draconian FERA and replaced it with a fundamentally different legal framework, FEMA, the Foreign Exchange Management Act.
Look at the semantic shift in the title. From regulation to management. It represents an entire macroeconomic revolution. The objective was no longer to police and hoard currency, but to actively facilitate external trade and payments, and to promote the orderly development and maintenance of a robust foreign exchange market in India.
Under FEMA, the shackles came off.
Mm.
The government vastly expanded the list of allowable current account transactions. They liberalized the export-import policy, dramatically raised the investment limits for foreign direct investment and foreign institutional investors, and paved the way for massive cross-border mergers and acquisitions.
Businesses were finally allowed the flexibility to hold foreign currency accounts and execute complex international transactions without seeking bureaucratic permission for every single dollar. And this maturation process continued.
The source highlights a final, critical milestone in 2008. In that year, the Indian financial system introduced currency futures trading for the rupee and US dollar pair on domestic exchanges.
The introduction of currency futures was the ultimate signal that the Indian Forex market had come of age. It provided domestic corporations with transparent, exchange-traded access to the advanced derivative hedging tools we discussed earlier. It allowed an Indian manufacturer to protect their profit margins from global volatility using modern financial engineering rather than relying on state protectionism.
From the suffocating surrender requirements of FARA in 1973 to the dynamic, market-driven hedging of FEMA and currency futures in the 21st century, it is an incredible journey of an economy learning to navigate the deep waters of international finance.
It is the ultimate synthesis of everything we have discussed. It shows how the abstract accounting of the balance of payments drives the brutal reality of economic crises, which in turn forces structural reforms, ultimately reshaping the entire foreign exchange ecosystem.
And with that, you have officially conquered the ultimate deep dive into Unit 7. Let's execute a rapid, high-level sweep of the mechanics we've unpacked to lock them into your memory for the exam.
Okay, we established the BoP as the ultimate national dashboard. Remember the accounting quirk? Credits on the left, debits on the right. And remember the golden rule. Inflow of foreign currency is a credit. Outflow is a debit. Exports are credits. Imports are debits.
We split the ledger into the current account, tracking the day-to-day trade of merchandise, invisible services, one-way transfers, and investment income, and the capital account, which tracks the long-term ownership flow of FDI, liquid portfolio equity like ADRs, and massive foreign debt instruments like ECBs.
We traced the historical trajectory. We saw how the inward-looking import substitution policies of the 1960s weakened the foundation, setting the stage for the catastrophic 1991 BoP crisis. We walked through the perfect storm of high deficits, depleted reserves, and the Gulf War oil shock that severed remittances. And we explored the massive structural turnaround driven by the IT services boom and financial liberalization.
We mapped the actual plumbing of the Forex market defined under FEMA. We looked at how commercial banks provide vital credit for global trade and how central banks like the RBI act as the ultimate stabilizing force.
We distinguished between the immediate spot market and the forward market, explaining how premiums and discounts are priced. We broke down the mechanics of currency derivatives, demonstrating how a forward contract isn't gambling, but an essential insurance policy protecting corporate profit margins from disastrous exchange rate volatility.
We analyzed the spectrum of exchange rate systems. You now know that devaluation and revaluation are deliberate government actions under a fixed regime, while depreciation and appreciation are market actions under a float. We saw how India navigates the middle ground with a managed float.
We explored the theoretical bedrock of purchasing power parity. We learned why absolute PPP fails in a world of tariffs and shipping costs, and why relative PPP proves that a country with higher inflation will mathematically see its currency depreciate over the long run.
And finally, we tracked the institutional evolution from the severe hoarding mentality of FARA to the modern facilitative management of FEMA. You don't just know the definitions anymore. You know exactly how the gears connect.
But as you close your textbooks and prepare for the exam, we want to leave you with one final, provocative concept to analyze. The entire framework we just discussed, the BoP, FEMA, the central bank interventions, it all relies on the premise that global trade flows through traditional commercial banks, where governments can monitor and regulate every transaction.
The ultimate bottleneck.
Yes. But look at the technological horizon. As decentralized finance protocols and sovereign-agnostic digital currencies begin to handle massive volumes of cross-border value transfer completely outside the traditional banking ledger, how will a central bank accurately calculate its balance of payments in the future?
Wow, yeah.
If $1 billion of value flows across a border via a decentralized blockchain, bypassing the commercial banking system entirely, how does the RBI manage the flow? The technological tools of the 21st century are on a collision course with the macroeconomic frameworks of the 20th century. It is a fundamental disruption that your generation of MBAs will have to solve.
A diagnostic landscape that is only going to get vastly more complex. Best of luck on your exams. Trust your grasp of the mechanics, stay intensely curious about how the world actually works, and keep diving deep.